Ladies and gentlemen, welcome to this new episode of Stoic Talks. This podcast is presented to you in collaboration with DSP Mutual Fund. Today, we have with us Anish Teli. He's an MBA from ISB and is currently the managing partner at QED Capital Advisors. He has co authored two research papers on momentum and conservative formula and is a go to authority on factor investing in India. In today's conversation, we delve in depth behind the intricacies involved in factor investing, particularly focusing on momentum and low volatility. I'm sure practitioners of the game will pick up some valuable nuggets. Listen in. Right. Welcome to the show, Anish.
Thanks, Manish. Thanks, Puneet.
I'm really
Great to have you,
excited.
Anish. Yeah, I am equally excited. A topic very close to my heart, and I think Manish's heart also. So let's jump in straight away. Manish, I would this time I'll take a back seat and I'll let you ask most of the questions. But go ahead, let's start.
Yeah, we'll start with the background itself. Let me first give you a brief as to why I'm excited. I have been following Anish's work for quite some time, and to be honest, and I don't know why, is it lack of marketing or whatever, he's not as much heard as he should be. And so I think Stoic Talks is filling that void by doing this podcast. So, Rish, welcome to the show. And let's start from the very basics how you got interested in the markets. And because I know a bit about your background, that you were primarily a fundamental investor, if I'm not wrong.
Yeah.
Uh, what's the transition? What led to the transition? And talk us through that.
Yeah, in
So,
fact,
so
Anish,
I'll,
I would just say that start from the absolute start, your educational background, and so on and so forth, so that people get the color of how your journey has been from the very start.
sure. I finished my CA around the dot. I mean, that gives my age away, but around the dot com time, and we used to make a stipend of around 5,000 rupees, 6,000 rupees around that time. So I made in '99. And I was interested in the markets because my father, although he's a doctor, he was also interested in markets. So he used to get this magazine called Money Magazine and the Wall Street Journal and all of that stuff home, and Economic Times and all of that used to come. And I was very interested in reading also. So slowly, somehow, that way, that's how it started. And then I got into commerce and I started doing my CA. So so the last final year of my CA is when I decided to invest that stipend that I had made, and I made two bets. One was in Steel Authority of India, and one was in. Once I give you the name, you will know that it's no longer. That company no longer exists. So they used to make these Fiat cars, which were these black and yellow cabs in Bombay.
Right.
Premier Padmini, I think it was called.
Padmini. Okay.
Yeah. So the bet was very simple. In both cases, Steel Authority was trading at around 0.25 price to book, and Steel Cycle was at its lowest. So the bet I was taking is that the government is not going to let this company go under, and it was available at 5 rupees, and ultimately, so I bought half my money. I bought Steel Authority, and that went to 4x. And the other side, the bet was that this company has a large land bank in Kurla, this company that used to make Premier Padmini, and one day there'll be value unlocking, and they're going to develop that land and all of that. That company shut down. That investment went to zero. So on one I made 4x, and on one I made zero. So that's how my journey started. And with that, I had done my schooling in Calcutta. I was born and brought up in Calcutta, and then I moved to Bombay after uh, after 2000. And I started work here. I worked for a couple of years with a CA firm in doing corporate finance again. Then I went to ISB Hyderabad to do my MBA, and post that I joined ICICI Venture in private equity. So it is as as fundamental as it gets. You're looking at early stage companies, mid stage companies, and and I used to focus on the pharma and healthcare sector along with other new projects. some of the companies which I invested in was now very well known. Bharat Biotech. At that point in time, nobody knew about it. So Bharat Biotech was one, Metropolis, uh, then some couple of other hospitals in Pune. So that's how that's, and that was like again the golden period 2004 to 8 when stock markets went up 4x. And in 2008, believe it or not, how great my timing was. I decided I joined Morgan Stanley Private Equity, and that's when and even though we were reading all about the housing crisis and this and that and all of that, and we are, but he said no, all this doesn't once best turns went down, we said okay, up to it's reached its end, so now things are fine.
By the
And
day.
in June, yeah, by the div, so in June 2008 I joined Morgan Stanley, and in the next 2 months was like, we went through that. Now everyone's familiar with that story where we were the last Morgan Stanley and Goldman Sachs were the last two investment banks standing between disaster, and luckily for us, Lehman went down before us, and overnight the Fed decided that Morgan Stanley and Goldman Sachs will become holding companies, and so so every day people used to come and check the stock price. The moment if it goes down from $6 to $5, game over. So, and every weekend that you used to go home, and Monday morning we come, Merrill Lynch is gone. The next Monday you come, Bear Stearns is gone. The next Monday you come, Lehman is gone. So it
Wow.
was like a crazy time to like so somehow we got through that time, and I spent another 3.5 4 years at doing private equity. So we had a third party fund which focused on Asia, so that was a good exposure, again looking at China versus India, and seeing the scale that is there in China. And when we used to compare scale in India, looking at hospitals, sometimes the whole hospital here would be a floor there. That they used to say that, are you sure you got all the numbers, because the numbers you're talking of are like really small, but he said no, this is the scale that you have in India, and that is the scale that you have in China. So that gave a very very good perspective. But around 2011-12, I think I wanted to go back to public markets, which I continued to track during this while, but because of regulatory constraints and this and that, I could not uh, be very active in those markets. So in about 2011 12, I decided to move out, and I started that I'll take a couple of years and you know s- uh, start investing my own money first, and then take it from there. And the journey that started from there, has led me to such places which I never imagined I would ever go to. uh, but the first couple of years, what happened was that I was we were making good investments. We were picking good stocks. I had my group of fundamental investors. So we bought the Astral Polys and Ajanta Pharma, which all these stocks that took off around that time. So again, it was not very difficult to do it. We were just starting off. That 2012 rally was just starting off, but somehow I was not making those crazy outsized gains, and that was, and the primary issue that I discovered was that everybody knew when to buy, nobody knew when to sell. And then I watched a couple of episodes of the Ramesh Damani used to do this series on television at that point in time with investors, and I came across the book by Jack Schwager, Market Wizards series, and then I started reading about investing, and then I got started looking at systematic investing and quant investing and things like that, and then slowly that I just said, okay, let me go back and examine my investments over the last 3 4 years. And one thing that was repeated in all those interviews was that you have to have a stop loss. You have to know when you are going to get out. You have to know what, and but in when we were, and it's very different when you're doing it at an institutional level, because there it is all done by consensus and committee, and it's a very different ball game versus when you're doing it yourself, because here you have to decide, you have to live with it, you have to do everything. And for the love of God, I could not, say that okay, how- when do we need to exit? So that led me to just redo my portfolio, and I went and sort of back tested all my trades, and I said, okay, what happens if I just put a 10 to 15% stop loss in my investments? So I also had other shit also, right? Like IVRCL and IVRCL assets and holdings and things, companies that don't now exist, Halonix, and at some point in time I sold them. But once I put the stop loss thing and I did all my trades, so the return on investment that I was making in those 2 3 years was about 18%, 18 to 19%. Once I put that stop loss in, that return went to 32%. And if I had not, and I said, oh, what if I had continued holding on to those companies, which I sold at maybe 30% down, 40% down? If I had continued holding on to those companies, my return was down to fixed deposit returns around 8 9%. So then something, I mean, that was like a light bulb moment. That was, if I can automate my selling, why can't I automate my buying also?
Yeah,
And
sorry
then
to
that
interrupt,
whole,
Anish. So the thing that you're talking about, I actually went through your webinar where you've extensively shared this backtest. So what
yeah,
I'll probably do is that we'll provide the link of that webinar below with this presentation, with this
yeah,
podcast.
sure,
Please continue.
absolutely. So that was that light bulb moment or epiphany, as you may call it. So once I discovered that, and I said, okay, maybe ये तो अच्छा है. Maybe let me see if I can automate the buying part also. And then I started this whole process of saying that, okay, now how do I screen the buyers, and how do I screen the buy list, and how do I rank it, and all of that. And so then I got introduced to, then Mark Minervini's first book came out around that time. And then from there I went to CanSlim, and then I backtested the whole CanSlim model. And again, CanSlim is a framework as such. It's not really a system that comes with it. It gives you the broad framework. So then I came up with my own ranking model, how to do the ranking. And then I would talk to friends who were some were in fundamental investing, or some were working but also investing. And then I would show them that like how we'd share our questions, and what we our learnings. And they would all say, yeah, yeah, we understand what you're saying, but it looks good, but why don't you just do it for us, and here's our password and login, तो आप कर लो. I said, no, it doesn't work like that. I can't just take your login password and start managing money like that. So around 2016, I applied for PMS. I said, okay, fine. It anyway is a fairly lonely profession. When you're investing. So I said, it'll be good. Maybe we'll have like-minded people join us, and grow slowly along with that. So I started with that kind of model, and then slowly, as I started doing more and more research on CanSlim, and then I got introduced to factor investing, and that's when I saw that you can make it even more simpler and even more robust. And simpler doesn't mean simplistic, but you can make the whole process a little bit more simpler. And so yeah, so that's how it all started. And then and in 2020 I met Rajan, and then we started doing more research, and Rajan was interested in doing it in a more formal way. So I think that really helped me also to formalize, because until then we had done all of us had done our own back tests, and done, okay, it works, it doesn't work, and people would say it's curve fitted and this and that and all of that kind of stuff. So all those doubts used to be there. But once I went through that process with Rajan again, in 2020 21, then obviously uh, it was very clear to me that this kind of investing also works in India. And India is not different. India is not different from, we don't come from a different planet. Our stock market does not come from a different planet or something. All those strategies and all those things, if you stick with it, if it's constructed scientifically, if it's done properly, if you and most importantly, you follow it in, especially through the tough times. I think what people cannot replicate is your conviction. And they can't replicate, I mean, I can, like Manish can give his strategy, You can give a strategy, I can give my strategy, and we can just put it out tomorrow. But people will not have the conviction to follow it through unless you have been through it uh, 4 or 5 years and learned, and you are able to follow it especially in the tough times. So yeah, so that's how the whole journey has been till now, and I think it's a lot more is yet to come.
A little more on this, Anish. I wanted to dig deeper on this transformation from fundamental to quant. How acceptable were you when you actually did that? I mean, your colleagues.
I'll just also add the same questions. I noted down that question for myself. Uh, you know, so when you answer Manish questions, just add some perspective about how and what you were doing when you were approaching the companies purely from a fundamentalist perspective. So before your can slim days or factor investing days, what was your process of picking up stocks? Because what you mentioned was your problem of selling or not able to buy or hold for a long period of time for outsized return. But you probably seem to be comfortable with your buying process in general.
Correct.
So what was your process then? And then when you moved from there to CanSlim, what shift or CanSlim or whatever, what your next step was, what shifted? So that might be a good transition to understand.
Sure, sure. So that's both questions. So the process again was fairly simple. In that we used to be a group of friends, and we used to share investing ideas, and then we would look at companies with growth. Same process, looking at ROE, looking at the margins, looking at whether the sector is in focus or not. So the same analysis that all fundamental investors do today, and then it was basically top down, that you come across an idea, you research it, you do all the number crunching, and then if you feel that this is an investable idea, and that companies in that sector are looking to do well, then you start buying, start with a small position, start tracking that company, and then once you see your thesis playing out, you keep on adding more and more to that and start building your portfolio that way. So we were looking at the same same things, whether the sector is attractive, how large is the market, uh, how is the promoter, what is the reading the call transcripts, seeing what the promoter has said was and what he's done. So all those kind of things, that what fundamental investors do, that simply was our process, and that's how that's how I used to do it, as I was investing my own money. And obviously, when I was doing private equity, it was much more rigorous, because you do market studies, you do a very thorough financial due diligence of the company's past. You go sometimes you go forensic also, so trying to understand if there is something that if something is suspicious, then you try and do the forensic audit. So all those tools were there in my arsenal, and that, coming to Manish's question, that was a bit of a stumbling block in my transition, because I had a lot of these preconceived notions about that yeah, I've spent about 10 years, a decade almost, learning all of these things, and now suddenly what I'm discovering is that I can do without it. I don't really need to do all of that. And then I that's how I came across Canclim, and I said, okay, yeah, this is a good mix, this is a good night, because it's making use of my fundamental background, as well as my newfound knowledge of quantitative investing or systematic investing. So this is a good blend of the two, and that's how I felt comfortable then doing that, because I still didn't want to let go of my fundamental background. So Cancellum was, you're taking current earnings, you're taking annual earnings, you're looking for a catalyst, which is something new. You're looking at whether the company is a leader in the sector or not. You're looking at whether there's institutional buying in the company or not. And the last one is whether the market is in an uptrend or not, and that's when you buy. So, it sort of was a perfect sort of model for me to say use my previous experience as a fundamental investor, along with making it in a more systematic manner. But yeah, it was very tough early on to even now sometimes, I when I had to buy, say there is some railway stocks recently, or I had to buy some say PSUs, which came in the momentum system. Even maybe 4 years ago it would have been very tough. Now it's now it's not so tough, right? Because we whatever comes up in the system, we position size, send it to the dealer sends it to the broker, and we just execute. Now execution is not really a problem, but yeah, until 4 5 years ago, it really was a barrier. Like I said, it's you have to change a lot of your beliefs. You have to change a lot of uh, you have to even go through that process. You can't change overnight. It's very tough.
So, Anish, I'll formally come to your selection mechanism, portfolio management style, etc. in later in the podcast. But to get a maybe a side thing from what you just said, can you also briefly explain how do you tackle? And it's a very common question which comes to people who do not do more data centric work and do more qualitative work. A common argument is that there are many subtle or not so subtle but very important qualitative factors which are extremely difficult to convert into either a number, fair point, and and the second thing which they always say is if you don't do that, you are always running the risk of not doing the entire research of the company properly, so you will miss a lot of things which are important for the company. uh, does
Yeah.
that bothered you? And if it did bother you, how did you tackle this issue at all? Or later on you realize probably that's not an issue, whatever your point is on this.
Yeah, so one other thing that I should mention, that I was and I still am a Warren Buffett fanboy. So he's the ultimate guy out there, and as people have gotten that I think what you're mentioning in that world is called scuttlebutt. That if you've gone there, seen the company, seen the factory, have you spoken to people, have you done your channel checks, have you done all of that work?
Not
But
only that, but even the
yeah,
even the
met
nuances to accounting which
met the
probably cannot
management or
be.
something.
No, no.
Yeah,
So yeah, all those are there. Also, so management factor is one which is very difficult to quantify as people. I mean, I don't agree with those things, but I'll come to my views later on.
yeah,
I
yeah,
want your point of view on that. So management quality, people say it's not very quantifiable, but it's extremely critical. Channel checks, etc., as you rightly pointed out. And then there are nuances to numbers themselves, which are very
correct.
difficult to find out. For which people spend a lot of time on the accounting policies of the firm, you know, related party transactions, and the things which are definitely not quantifiably yes or no, but are gray areas which are often found in the hidden notes, etc., and which does add to certain risk factors or positive factors which otherwise are missed when you look at things quantitatively. So I'm talking about those also, not just the channel checks. Yeah, go ahead.
Yeah,
And while you answer that, let me add another twist to this. I was having this conversation with Manoj Dua, and he actually alluded to the same point. He said, "Yeah, I need to do this back test of your quant factors. What kind of extra excess alpha I am getting over and above you? अदरवाइज इतनी मेहनत करने का फायदा ही क्या है अगर खाली ये 4 लाइनें का कोड लिख लिख के ही वही रिटर्न आनी है तो या प्लीज अनीश गो अहेड."
yeah. So what you've said is correct, and there can be certain nuances that are there now. But how much are they worth? Is it worth your time to sort of get into that? And that is a fairly debatable question. And I do know that there are a number of fundamental investors now today who sort of go out there and accept that, and they say also that we don't meet management. We don't we don't want to meet management because it's like meeting a boy or girl on a date, or meeting somebody for a marriage proposal. Everybody's going to be on their best behavior. Nobody's going to tell you anything. No, you'll never meet a promoter who's telling you something which you don't want to hear. So, and I realized that in my private equity career, you don't get anything from, and other than understanding the business and all of that, you don't get any major, clue of how it's going to work out and what it's going to do. Now, I'll give you an example. There is this textile company in the south, making children's wear, and that came into the cancelim model very early on. And we bought that company. We rode it up. Then there is a academic value investor from your city who also liked that company a lot, and he wrote about it, and he said that it's a I label him as one of the best investors, and he's an intelligent fanatic and things like that. However, there was one issue with the company, that they always had a cash balance of something on their books, which they claimed was overseas, and that they had also had debt on the books. So in every conference call, they used to get asked that, boss, why aren't you getting the money back, and why don't you just set it off and get your debt to zero? Why are you paying interest? So they would hem and haw and say that, okay, no, we'll get it later, and we are trying to sort of, with the dollar is going to depreciate. Then the story changed to, we are setting up something in the US as a subsidiary, so we need money to spend on marketing there, and blah 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 blah. But by that time, I already had an exit mechanism in place, a quantifiable exit mechanism. And at some point in time, the price started giving me signs that, okay, this stock is going down, and I exited. And and after that, after I exited, the price went down 50 to 60% down more, on this premise alone, which was known to everybody, that there is cash on the books, there is debt on the books, but this guy is not getting the money back for the last 2 years. And earlier people did not know, but and even I did not need to know it, but because at that time I still had my fundamental thing, that I would look at the accounts, and I would read the analyst reports and all of that. So I knew that, okay, ये issue है, ये मतलब कि there is something not smelling right, but ठीक है, price is going up, it's come in my filter. Worst case, what will go wrong if you take a 5% position? So we took a 5% position, and but then that stock price crashed ultimately, when they found out that that the market stopped believing basically what the promoter was saying. So there's this great Richard Dennis quote which says that, at first I thought intelligence was reality and price the appearance, but after a while I saw that price was the reality and intelligence is the appearance. So what we say it in India in a very common way, bhav bhagwan je. Like so prices sense a lot of things in advance, and I've seen this now in many companies. There was this house building products company. People said it would become the Home Depot of India. Home Depot of India it will become. And we also had bought that company, and we exited after that. Again, when the fancy went away, it fell down another 70-80%. So I said, what are all these people smoking, and how do you get that belief that uh, to overlook? I certainly don't possess that, and I think that price is more intelligent. And as a fundamental investor, you are taught that the market is wrong, you are right, and one day the market will catch up with you. Whereas as a systematic investor, you are saying the market is right. I'm reacting to what is happening, and I am going to go along with what is there in the present moment. And I think that is the biggest mind shift that one has to make, and that, because once you give away that power to the market, people are asking you, so what are you doing then, right? So what value are you adding, or what value are you bringing to the table? And I think that's where people get that wrong, that uh, that if you've done all this analysis, all this thing, but if you still don't have a good exit mechanism. Somebody like Warren Buffett has it. He read IBM reports for 50 years. 50 years he said, I read IBM reports. He bought it, he went wrong, and he exited in 2 years. He was out of it. No emotion. He bought airlines first time. Then he said, they should have a helpline for some people like me who can't but stop help but investing in airlines. He exited, and again during COVID, he had a large position in airline. Again overnight, within 2 months, he sold all his airline stocks and all of that. No emotion at all. But people don't. I think most people fail to see that part of his investing process. They all focus on what he bought, what he's holding, but they don't focus on what how he sold off all his laggards. And I think that is something which is very hard for fundamental investors to do.
Right. So, Anish, let's now bring a bit more concreteness to the working style, the investment philosophy. So broadly, I think the audience would have understood your style by now. Let's get into the actual workings and go from there. So, generally we break down into three parts. So, let's start with the stock selection. Before that, if I can understand, how do you look at a portfolio? Because you are into PMS. So when you say you manage a portfolio, how do you either differentiate to different types of portfolios, or you try to manage one portfolio and bring in whatever you understand into that portfolio? How do you look at a portfolio, and how do you construct a portfolio?
And
Right.
and while you're answering that, Anish,
Yeah.
also give it a framework as to what's the overview strategy that you follow, because I'm pretty sure
Yeah.
audience must not have picked it up as yet, because we associate you with momentum. Maybe there's conservative formula, or
Yeah.
what is it that you do?
Right. Uh, so the so currently, where we have arrived, or I have arrived in my journey today, is we broadly follow what is called factor investing. Now, factor investing in that sense is very similar to in fundamental investing. Is that you're looking at investment styles per se. So one value is the first factor which was discovered or sort of proposed by academics French and Pharma was the value factor in 1992. They said that buying a portfolio of cheap companies does better than buying a portfolio of expensive companies over a period of time. Incidentally, along the same year, that Jagdish and Treatment came with their momentum factor, which said that companies that have done well in the past, they tested 3 to 12 months, continue to do well in the foreseeable future, and companies that have not done well, they continue to not do well. That trends, the momentum sort of continues. The third one is quality, where which you say that buying quality companies which have high return on equity, or have high gross profit margins, or they have high return on capital employed, those type of companies do better than companies with low ROEs or low ROCs or low margins. And typically, these companies tend to come from more stable sort of industries. So these are the three, four factors, and then there's the fourth factor called low volatility. It's still somewhere between an anomaly or a factor, which again is a little bit contrary to the capital asset pricing model, where it says that high beta, if a beta of a company is high, that means its expected return should also be high. But in reality, it does not turn out to be so. It turns out that companies with low volatility turn out to be much better over the long run than companies with high volatility. And today now we have all have data on all of this. The NSE has indices on most of these factors. They have the process laid down, and they have the methodology. So that's how we look at it. And then what we want to do is that the first one that I started off with was like Manish rightly mentioned, associate me with momentum. So we started off our first portfolio with the CanSlim model was actually to buy companies with high relative strength, which is nothing but momentum, but and with good fundamentals, which is where you are seeing a good growth in profits, or a good spurt in profits over the last quarter and the last year. Now, what I found in my research as I was going along, that somehow this spot in growth is sensed by prices also. I have not come across companies which have done well over a period of time. Maybe there are companies that we have held on for a couple of years also, and it's not been a case where the fundamentals have not supported it. It hasn't happened, except in very few cases. But most of the time, the fundamentals also support the price momentum. So somehow, I when we went back and saw those companies, we said that okay, you don't need to add in an additional factor, right? Because it again complicates things. And Being an accountant, again, I know the challenges with taking accounting information and making it standard across industries, or making adjustments to it, one time adjustments and things like that. And I said, if you can make it simpler with price and build in those safeguards there, why do you want to add additional factors? So we took momentum and we took low volatility, and that's how we came up with our first portfolio, which is called Alphabets.
So
And
earlier, just to paraphrase, you were earlier looking at not the balance sheet, just the earnings and the price, and later you graduated to figure out that this is, anyways, not covering. Just the price is covering all the bases, so you discarded the earnings part of it and
correct again,
included
yeah.
low volatility.
Correct. And again, recently we've started looking at price, but we're looking at earnings, but we are looking at earnings acceleration, and whether that gives us any additional information in certain cases. So we are seeing if that can help. But what I'm seeing so far is that it's not going to change things majorly, but it's good to have. It may help us to sort of filter out some companies which are not kosher, or not, perhaps not going to do well. So is there an additional filter that we can add? But we're still working on that, on earnings acceleration. So so yeah, you're right. So we said that, okay, we are looking at all these companies. We saw a portfolio, and most of those companies were doing well fundamentally also. So we said, let's make it a little bit more simpler and not to complicate things, because then you would look for one time items. You look for, why has this suddenly grown, why has this suddenly fallen off, why has growth suddenly fallen off, and things like that. So we started with momentum and low volatility, and that's the first portfolio that we started off with. Uh, However, the momentum also comes a little bit with high churn, and we said that that's a good satellite portfolio to have for most investors. Now, one of the, the free lunches in investing is diversification, and similarly, you can also diversify among factors, because even factors are cyclical. Not momentum does not mean, as Manish will know, and as you will also know, that they don't, just because it's momentum does not mean it's going to work all the time. We've gone through horrible periods in 1819 when it was completely sideways. Even last year we went through that period when momentum was sideways, and then suddenly in March, April of this year, again suddenly momentum, mid cap momentum especially, picked up. So it goes through its phases, it goes through its cycles. So then we said that, okay, is there something we can offer to investors, uh, which will give them some sort of diversification as well as the benefit of momentum? And that's where I came across this uh, paper written by Pim and Fleet of Rubeco, called the Conservative Formula, which takes into account momentum, low volatility, and value. Now, most studies in the US and in rest of the world, as well as in India, the paper that I wrote with Rajan, called Long Only Factors, Not Short Change, we also found that value and momentum have the lowest correlation. And they also, in some cases, it also has negative correlation. So when value is working, momentum is not working, and when momentum is working, value is not working. So so if you sort of blend those two together, your ride can be a little bit more uh, smoother. Yeah, it can be a little bit more smoother. Plus, it's also easier for to explain to people when you explain value, because they are used to that kind of uh, narrative. When you talk values, सबको समझ में आता है. Yeah, you're buying something that is worth less than, you're paying something that is than what it is worth, less than. So value, everybody understands. Momentum, they understand. Okay, now a lot of investors are understanding momentum. That, okay, you're buying what is doing well. And when you add that, so we said that, okay, we are looking building a core portfolio, which will not be as high churn as momentum, because values signals tend to uh, take a slightly longer term than momentum signals. And we are getting a little bit technical here, but momentum signals will sort of, you need to have a faster rebalance than value portfolios. So we said that okay, this churn is also not too much, and it's also giving diversification. So we came up with the we tested the conservative formula for Indian stocks, and we found that surprisingly it did extremely well.
Stoic Talks has been partnered by DSP Mutual Fund, which was an obvious choice for us, having worked with the DSP team earlier and recognizing how they're obsessed with helping investors take better decisions. Some examples of their motivation to help investors do better are visible in their research related work, which they make available for free, including Getting Smarter, Tathya, Report Card, their Invest for Good blog, among others. We thank Team DSP for supporting this episode of Stoic Talks and recommend that you follow them on Twitter at DSPMF. So,
And
Anish, just a second. I'm sorry to interrupt you again. It's very important for our audience to know what conservative formula is.
yeah,
I'll let you talk about that. But before you do that, let me bring the base. I was just going through the numbers. This Pim Van Vliet, uh, the guy who did this backtest on the US stocks, the conservative formula has been so awesome that it produced an annualized return of 15.1% over the period of, and it's a big long back test starting from January 1929 to December 2016. Basically
right.
covers all the phases of the market. Now, this is significantly outperforming the US market index by 5.8% per year. And they also then did this backtest on other countries as well, and the outperformance in Japan and other countries was even more stark. So
Correct.
please go ahead and walk us through the Indian side of the backtest.
Yeah. So, when we started looking at, so I had done a sort of a rough back test of this, and I found that it does work, but I was finding it a little bit difficult to get reliable data going back all the way to. I had done it for a decade, and I wanted to do it for a little bit longer period. So again, I spoke to Rajan about it, and he said, "Yeah, yeah, let's try it out." I'm also intrigued by what the results will be, and that's how we tested the conservative formula. So conservative formula is fairly simple. What it does is it takes you take a universe of say 1,000 stocks, the original formula, then you take the 3-year volatility and you sort it from low volatility to high volatility. Then you take the top 300 stocks ranked by low volatility, and in that universe of 300 stocks, you calculate the momentum of that universe, stocks in that universe, and you calculate the dividend yield of that universe. Actually, you take shareholder yield, which is dividend yield plus the buyback yield, because in the US, a lot of buybacks also happen. So dividend yield plus buyback yield, which gives you shareholder yield, and that's a proxy for value globally. And so you take so in that universe of 300 stocks, then you rank it, you double sort it by for momentum and value, and you buy the top 100, 50 or 100 stocks. So we tested it on buckets of 30, 50, and 100, 30, 60, and 100 stocks. Um, and and you rebalance it quarterly, so it's something that it's not very high churn.
And this was
So
equated.
this was equated, yes. So we ran that backtest all the way from 2006 to 2022, and we found that even that does pretty well in India. And in the momentum portfolio, we were focusing more on the mid and small caps, because we didn't think there is too much place for momentum in the large caps. But this portfolio does very well even with large caps. So with this, we can give clients exposure to large caps, and that can be a core portfolio for them, and we can add the momentum portfolio as a satellite portfolio, as an allocation, separate allocation. So that's how we then started with this core equity based on the conservative formula. Pim Van Fleet himself was kind enough to review the studies, for India, and he went through the studies, and he was quite happy, and is not surprised, but he said, yeah, it gives me validation of one more country, that it works. It's a universal thing. It's not just a European thing, or it's not just a US thing, or it's not a developed market thing, but
Yeah, yeah. In fact, when I did a Wikipedia search of conservative formula, your paper is also cited in there. Yeah, as
yes,
an
yes,
India example.
yes, it's been added in the conservative formula Wikipedia page. So that, I think that's also given me a lot of confidence to follow the strategies that now we've done it. So one of the things that one of and I'm sure you also know that are I look up to these people at Alpha Architect, and everything that they do is backed up pretty scientifically by data, by processes, by because ultimately, see, if you're doing, one of the reasons also I started with the PMS, like I said, was it also inculcated a sense of discipline. When you're doing with your own money, sometimes you can get a little bit, you're not following the process, or you can be take a little bit more leeway. But when you have third party money, when you're managing somebody else's money, that makes you much more careful. It makes you much more disciplined, and you have fiduciary responsibility. So you want to do it in a as scientifically as possible, and plus, since this was something new, if for people in India, so it was not an accepted norm to do something quantitative. Of course, today now, even fundamental investors are coming out with quant portfolios, and their quant portfolios are outdoing their fundamental portfolios. Surprise, surprise. So that's how we started with the conservative formula and core equity. It's been about a year, and I keep tracking, how it's doing vis-a-vis the backtest. We keep extending the backtest, and it's doing in line with that. And we've systematized the whole process, and now it's fairly, uh, you know, easy to run it on a quarterly basis.
So it's equi-weight and quarterly rebalance. Did I get that correct?
Yeah, yeah, yeah.
Okay, so Anish, I'll just take that and delve a bit deeper into it, right? So from what I understand, you have one portfolio, and that one portfolio is primarily broken down into, let's say, two parts, right? One being the core part and one being the satellite part. Is that a fair understanding, or you have two different offerings?
We have two different offerings, because some people may want to just take exposure to the core part and do not want the high churn part. Some people are saying that, okay, here's the money, you do the allocation how you want to do it. So we've kept the both of them separately, so that you can also track the performance separately of both the portfolios. You know what's working at some point in time. So we've kept both of them separate, and they are both separate offerings.
Got it. So let's also, because you are trying to do core and satellite from the vantage point of diversification, because as you said, core is more value, and I think you are doing the conservative formula in the core,
Yeah,
right?
yeah.
And the satellite is more focused towards the momentum and the low ball working. Now, and you're saying there's a diversification benefit to these two
Correct.
working together, right? So
Correct.
when you do that, uh, how do you maintain? So let's say if the client comes to you, is the proportion that goes to core and the proportion that goes to satellite, if the decision is left up to you, does that change over a period of time? Is it like a fixed proportion? Does the market condition decides how much goes into core and how much goes into satellite? Just run us through the allocation at the top level, not among the stocks, but at the top level, how do you decide how much money should go into what?
So typically, we explain both our offerings to the clients, and we explain how both of them work, and what are the broad returns that both have delivered, and what kind of returns one can sort of uh, has one has generated in the past. But the allocation again comes down to, it's a lot of driven by client preferences, and it's driven by where they are in their journey as an investor. And so sometimes, so like for example, one client who's come to us already has a portfolio of mutual funds, and has index funds at the core, and he's saying, look, I'm just looking to add to my current core portfolio of index funds and the like, and I want to add momentum that the way that you are doing it. So for him, we are just giving him the full exposure to the momentum alphabets portfolio.
Uh,
Somebody else who's yeah.
Yeah, let me remove that from component altogether. Okay, so let me rephrase the question. Let's remove the client preference from the equation because the
Okay.
interest is more into the combination of these two strategies together.
Right. Right.
Imagine that you have a free hand and the objective is to maximize the risk adjusted return, which everybody is trying to do. With that objective, how these two strategies will work together over a period of time, over different market cycles, how do you think about that part? Let's remove the individual preferences.
Yeah. So in that sense, it again, they over cycles they will not be very different, but during this journey, during the cycle, I think that's where the real, what the client will experience, because it's very important for them. The first 1 or 2 years are very important for a client. You don't want them to experience a big jolt, or you don't want them to have a bad experience. So even when today when a client comes, we don't follow the approach of taking the money and allocating directly to what we are holding. We take time to build, even if it's, let's say it's one offering core alphabets, which is momentum. And if somebody comes and invests 50 lakhs with us, so we will not just go out today and buy what is there, because I may have a stock in that there which has gone up like 4 times. And and from a risk reward perspective, it does not make sense for the client to for me to put that money there, because somewhere from experience, and also from having seen it, that this is going to sort of give some pain down the line. So we tell them that, look, we will take 6 months to build your portfolio, whether it's the momentum portfolio, whether it's a core equity portfolio. We will do it in parts, unless it's very attractive and if you get a market fall or something of that sort. So then we will say that, okay, uh, we'll deploy it more aggressively. Otherwise, we will just take 5 to 6 months to sort of construct that portfolio. And then to when it comes to allocating, we can allocate. We start with 50-50, saying that, okay, allocate half to here where there's value is dominating, and allocate half here to where momentum is dominating, and then take it from there, and then we sort of start adding. And that's also how my own portfolio is again broken up. So that's something. Asset allocation or portfolio allocation is something even Paul Samuelson, who came up with the efficient frontier, or Benjamin Graham, who said that after everything considered, he just went equal weight. Equal weight turns out to be much simpler, and all these risk adjusted returns and all of that. Client, at the end of the day, they just care about returns. So you're saying risk is something that you have to manage. You tell me what is good for returns, and how will I go along with that. But yeah, if obviously if it's a client who is uh, who I know is not perhaps going to be able to stick to a high churn portfolio, and they have, then perhaps for them we would recommend something slightly lower. But if I am given a free hand and I am told that you just take the money, and there are clients like that, who are friends and family. They said, we don't understand what you are doing, but we know, we trust you, so just take the money and do whatever you want to do with it, in the sense that you take care of the allocation, and we are okay with broadly that. So even if you see in the paper, the conservative formula perhaps give a return of something like 20 to 22% over a long period, whereas the sharp based momentum, or the risk adjusted momentum, or momentum with volatility, whatever you want to call it, all different versions of it, gives similar sort of return over the long run. But it has a slight amount of high churn, and then you can have options to go to cash during some point in time. That is a big difference, and a big differentiation for us versus another offering like a mutual fund, which cannot go to cash, which cannot do certain things that we as a PMS or an AIF can do. So there, we say that, look, we've built in the guardrails, we've built in all of that. So we'll try and have a smooth enough experience as much as possible. but it's good for you to have exposure to both these because it takes care both at the market cap level that you have exposure to large caps and mid caps, and here you have exposure to mid and small caps, and you have exposure to different factors like value and momentum, which are sort of very low correlation with each other. So at one when one is zigging, the other is zagging, and vice versa. So to begin with, yeah, 50-50 is good enough to start.
Have you done any work on probably calculating the uncorrelation between the two portfolios?
Uh, you mean to say the
Your
correlation?
your two offerings, they
Diversification
have.
benefit of it. So basically, the correlation factor, how negative it is, if it is negative.
Yeah, yeah. So it's there in my it's there in the paper because see when one thing which again I don't want to make it again very technical for the listeners because a long short portfolio will have a much lower correlation than a long only portfolio because the long only portfolio a lot of it is has market exposure. So there the correlation tends to be fairly high between the between the long only portfolios. So a long only portfolio of say momentum will along with to value has a correlation of around zero point 0.6, right? And uh, and that same value portfolio along with the market has a correlation of something like zero point 0.9. So that in terms of correlation comes down to much lower. But if you look at the long short portfolios, the correlation is almost zero point 0.1 to sometimes negative.
Wow. Yeah, so it's fair to say that the two offerings that you have are basically catering to different target audience based on the kind of churn they are willing to take.
Yeah, different. I mean, how open they are, how they want to uh, because ultimately in the PMS offering you still have to do it in the client's portfolio. So they want to look at their tax status. Tax is a comes up as a point sometimes. So one where you have the low churn, sometimes people want to go with that. But so some people who are coming to us for diversification, they want to go completely for the momentum part.
Okay, great. I'll just build on that same question which I asked earlier. Most of so you said equal weighted is the way to go. Uh, will there be a scenario or in your backtest or whenever you have backtested, have you backtested a 50-50 across the board at all the rebalancing frequencies? So you must have tested both together also, right? Or you just tested the individual strategies separately and then you combined a portfolio to make it? Or is there also a backtest which combines the two together from a
Right.
allocation perspective?
So
Have
you're
you done
talking
anything
about
like that?
how, yeah, so that's how we came up with the correlation, right? The correlation between value and
No,
the
no, I'm saying
momentum.
the performance of a 50-50% to both these two portfolios, something of that sort.
Okay, performance of both these. So the performance will not be very different. The performance will be different, say over shorter cycles, or maybe over a 3 year period. Sometimes if momentum has done extremely well, and we've had very short cycles, then there can be a big gap in. But now value, for example, value started doing extremely well from November 2020 when the vaccine was announced for whatever reason that the and value tends to have more economic sensitive stocks, stocks which are more sensitive to the economy, more cyclical stocks. So things like, and now you're seeing this whole theme play out, like defense and PSUs and PSU banks and oil sensitives, interest rate sensitive. So all those and the value factor, long only value portfolio has outperformed, or has done almost equal to a momentum portfolio. Whereas prior to 2020, value was giving a return of say 9-10% versus a momentum portfolio was giving a return of 18%. But now in the last 3 4 years, it's almost come very close to each other. So over a long period, like if you're talking 20 25 years, I expect that it's not that these will diverge very wildly. But if you see the data also, now there's another way to look at it, is the odds of underperformance versus a benchmark. And in this book called Factor Investing by Larry Swedroe, Your Guide to Factor Investing, so he looks at the odds of underperformance of each factor over say a 5 year period or a 7 year period or a 10 year period. And uh, and not surprisingly, momentum has the lowest odds of underperformance. So over a 10 year period, it's almost 99% sure that momentum will not underperform the benchmark, versus for value, it's, I think if I'm not wrong, it's something like 80%. So value may tend to underperform sometimes, but momentum is perhaps one of the strongest factors out there. It is far more robust and stronger than most other factors, which has been found in data. Um, so yeah, so I think I don't know if that answers your question, completely, but I would say that in terms of expected returns going forward from here, uh, over a long cycle of 5 to 10 years, you may my preference, my gut feel would be that perhaps sometime momentum will do better. But if but everybody is not out there, surprisingly, for just getting the best return. There some people who made their money, they are like, boss, just take care of the money and make sure it grows. And some people who are young enough and they want to take the risk, they want the highest return. So sometimes even objectives come to play.
So, Anish, so yeah, I will not drag this point a lot further, but I'll
Yeah.
just add one more question because I just need one more clarity from the way you think about this particular flow of money from a return maximization perspective. If you have to think about that, okay, will there be a time when you would probably take the money out of the core and shift more towards the satellite, or vice versa? Or you always think that you will always have enough to keep, I mean, you'll do 50-50 both, and if the opportunities are not there in value, you'll probably go to cash in the value wala side, and if the opportunities
Yeah.
are not there in the satellite, you'll probably go to cash in this. So how do you think about this part? Or will the cash maker flow from this to this satellite, I mean, this to the strategy?
Yeah. So, factor timing is something which I keep having a discussion with many people about. With Rajan also, we keep discussing it, and he says, if you find something, please tell me about it. And even, uh, the one of the original quants, Cliff Asness, he talks a lot about factor timing. Can you time factors? Now, also there's, again, you can get into more esoteric and meta discussions, whether momentum is a factor by itself, or momentum is the reason that drives all the factors. That, is there momentum in factors also? So then the other way to try to time is valuation. That, is there a big spread in valuation between the growth stocks and the value stocks? And sometimes you can see that, okay, if there's a big spread and it's going to mean revert and correct itself, then probably go towards more, allocate more to the value part of your portfolio and less towards the other part, the momentum part. And however, even Cliff Asness says that, it's very difficult to time. It's very difficult to say. I mean, they've been saying for the longest time to allocate more and more to value, and the value factor. When I say value factor, I mean long short, has had a horrible decade from 2010-11 onwards, when QE started, and interest rates started going down. And from 2020 onwards, it started recovering a little bit. So it's very hard to say. So, but he does say that if you must sin, then sin a little. That if you feel that some factor is more attractive, then okay, fine. It's okay to take a slightly higher allocation to that factor, to try and see that if it has it has uh, it may give you a little bit more outperformance in the long run. But overall it's very very difficult to sort of try and time something. I mean, within the factor I can say that okay, we are not seeing a lot of momentum in certain stock in the universe right now, or say a situation like 2020 occurs, or a situation like 2008 occurs, where you know that it's an obvious situation that you can go to cash and redeploy later, where your system will just not give you buys. That's how we've configured it. uh, but those sort of come maybe once in 5 years or once in a decade. Those obvious kind of scenarios.
But Anish,
But
technically speaking, this is not really factor timing, particularly the portfolios you have, because more or less both of them are same, isn't it? One has volatility and momentum, the other has volatility, momentum, and value. So the
yeah,
correlation is anyways pretty huge.
yeah, but Manish, the way we sort it is it makes a big difference, and also that one also has large caps. So even that correlation keeps changing, but the correlation between large caps, mid caps, and small caps. For example, in the last two years, we are, I think in September 2021 we were at around 18,250. Today we are at 19,050, maybe 5-6% higher, whereas mid caps are much higher than that. So even that rotation between market caps keeps happening. So that also gives another sort of diversification, and so we've purposely designed it that way so that you get exposure to different market caps as well as to different factors.
Okay, so Anish, now let's get into these two strategies separately and get into a bit more nuanced discussion about so we can start with the formation first, right? So in first case, ultimately you have to do stock selection, and then
Yeah,
you have to have, so stock selection is going to be based on certain buy rules, either at a stock level or at a ranking base or whatever mechanism you have, and then you will have the allocation rules around them, and eventually you will have selling rules around them, right? So run us through first for, let's say, either of the two. So let's start with, let's say, momentum and low wall, and discuss how you create the portfolio there, and then we'll move to the next portfolio later on. So let's start with the momentum and low wall and your approach to that.
so, in the momentum plus low wall portfolio, what we do is we take a universe of the top 500 stocks by market cap, and we remove the top 100 stocks. We take 400 mid and small cap stocks. In that, we calculate, the momentum score and the volatility score. We take an average of the ranks and take the top 20 stocks ranked by momentum and low volatility. We've tested it by taking momentum divided by volatility. We've tested it for momentum multiplied by volatility, which is Andres Klinov's way of doing things. He takes a sort of that approach. What some of the NSE indices take is, one is the the returns over the last 12 months divided by the volatility of the last 12 months, and another one takes Jensen's alpha, which is the excess returns, what is expected using the CAPM model, and the actual return that the stock has delivered. So all these methods we've tested, and we found that more or less they tend to give you the same returns again over a cycle. But during a cycle, all of them can have very different performances. The academic definition of momentum that way does not include any, has no mention of volatility at all. But it's just pure returns. But that we tested that again in our paper, and we found that it is extremely volatile. That kind of a portfolio, and it does help to add a volatility measure. So whether you divide by that momentum returns by volatility and take it, we did that in our paper. That turned out to give the be the best performing in terms of sharp, in terms of return, as well as in terms of having the lowest volatility. So
Just
we
to
did,
add
yeah,
to this, can you also define your look back period for the momentum
look
and
back
the
period. Yeah.
volatility when you're doing the ranking part?
Yeah. So our look back period is a combination of two look back periods. So we again sometimes you can. if you are in a fast market, then sectors are rotating very fast. There's sector rotation happening very fast. So, but sometimes it can have a longer signal. So we take a combination of two look back periods, 6 and 12 months, and we take and returns across those two periods, and then take the returns volatility of the last 12 months, and then do a combined ranking, and then take the top 20 stocks from that universe, and then we start with equal weight. So again, we've experimented with risk parity weighting, which is again allocating most to the lowest volatility stock and allocating the lowest to the highest volatility stock in that portfolio. It does not make too much of a difference, to be honest. And so we've just gone with equal weight, because we found equal weight to be the most simpler to implement, and it's also turned out to do better than the rest in the results also. So then, while we again look at it on a weekly basis, we don't get that kind of churn because of the look back periods are long enough. So, but I'm sort of intrigued, and I'm looking for some sort of switch where if I can figure out when the volatility regime is changing, then I switch from a monthly rebalance to a weekly rebalance. I'm trying to doing some work on that, and I think that will reduce the churn a little bit more, because I think will help in reducing the churn. So I'm doing some work on that, and I'm still experimenting to see if volatility can signal some sort of change. Incidentally, the the I got this, not my own brainwave. It's something that I keep reading these prospectuses and fund documents of these ETFs in the US. So MTUM, which is BlackRock's momentum ETF, they have this methodology where they rebalance once in 6 months, but if the volatility crosses a certain threshold, they keep calculating the change in volatility, not the actual volatility, but the change in volatility. So if this month it was 20 and the next month it's 25, that means volatility has gone up by 25%. Like, it's 5, it's gone up by 20, has gone to 25, or 20 has gone to say 30, or 20 has gone to 40. That means it's almost doubled in 1 month. That somewhat signals can be turn out to be a decent indicator of a change in regime. And if that happens, sure, they sort of trigger a mid period rebalance, and they rebalance their portfolio. So I'm looking at something along those lines, and I'm
This is fascinating, Anish, because I know a lot of option sellers in their strategy use this particular factor to decide if they want to sit out the market or not. The
yeah.
volatility as a factor is a interesting giveaway of things to come.
Correct. Yeah, it does. And I was actually even looking at some of the other, this Mark Faber and Gary Antonacci dual momentum kind of strategies, and seeing that using volatility also could you generate some kind of similar signals. And I found that you could do that, and you can also use volatility as one of the triggers to buy and sell. But that's a very completely different discussion. So maybe we'll park it for later. But yeah, so I'm looking at something like that where we can move from weekly, looking at it on a weekly basis only maybe shift from and do things on a monthly basis. Monthly, I think, is optimal, but weekly also we don't get so much churn, because we've designed it in such a way that uh, we exit only if we've given fair amount of leeway in the exit. So if it falls below a certain rank, then we exit, or if it falls below certain standard deviations from its own mean, then we exit. So there are two exit paths for a stock to go out. And if something goes out, and then we replace it with another stock which takes its place. So that's broadly how the momentum plus low volatility portfolio works. The core equity portfolio, like I said, is a quarterly rebalance. So there, it's I explained the process that you take. We taking the top 300 stocks by low volatility out of the entire universe of stocks, bring it down to 300. In Instead of 100 stocks, we because we thought 100 is quite wieldy to manage in a PMS kind of setup. You can do it uh, in a mutual fund setup, but for a PMS kind of setup, we think 30 is optimal. So we take the top 30 stocks by momentum and value. Incidentally, in India, dividend yield and shareholder yield gives you more quality exposure than value exposure. And we discussed this point with Pim Van Fleet also, and he said that you're right. That he found also that in certain countries, dividend yield is a measure of quality than of value. But even dividend yield also keeps changing its character. It sometimes gives you value exposure. It sometimes gives you quality exposure. So that's again a interesting side topic that came out of the whole analysis. So again, coming back to that, so we take the top 30 stocks which are by momentum and value from that universe of low volatility, and we then rebalance it on a quarterly basis. So every quarter we sort of run the rebalance and replace what is going out with what is coming in.
I'm sorry, I probably missed that part. But when you were saying low wall space, how much was the first starting point? 100 companies,
300.
300
300,
companies. Okay,
300.
sorry,
So,
my
so
bad.
out of the total universe of 500, we bring it down to 300.
Yeah,
And then out of the 300, then we take the top 30 on
based on
momentum
momentum and val.
and value.
Okay, so for the benefit of the audience, also let's just run through the value factors understanding, because majority of the time it's a confusing factor, because the way it is defined quantitatively is usually absolute absolute valuation numbers, right? So
Yeah.
a 1 PE is higher value compared to a 10 PE. I mean, just to give you a right. So and it's doesn't really take the company's fundamental in picture. So just for the benefit of the audience, define the way you are taking the value factor. Momentum factor is clear. You are. Acha, by the way, also just answer on the momentum side. Are you doing the same short and long 6 month, 12 months here also, or you're not doing that here?
So here we are just taking 12 months.
Okay. Okay.
Yeah.
So let's shift to the valuation value factor.
So value, typically is so in the original paper by Pharma and Friends, they took price to book as the metric because they thought that would be common and the most standard factor, which would be the same across industries. Because banks, it is pretty hard to value on a PE basis, and it's or price to sales or anything. But fundamentally, some people, when they're doing value and they want to exclude this financial sector, then they take they want to exclude certain sectors, then you can use any other value metric also. Uh, so price to anything fundamental metric, price to any to earnings, price to cash flow, price to sales, price to book, any of these can be used as a proxy for valuation. So saying that, okay, we are trying to buy something that is cheap in value. It's cheap for a reason, and uh, the behavioral quirk that you are playing here is that it's that the market has overreacted to something that is temporary, that something has temporarily gone wrong with this company, so it's fallen below its mean of going up, and then it will mean revert back to its original trend line. So you are buying something cheaper than what it's actually worth. It's because of overreaction by the market. Momentum is the exact opposite, where the market is saying, where the behavioral anomaly or the quirk that you are sort of trying to exploit is that the market is underreacting to good news. Because say HDFC Bank, which for the longest time, every quarter it would come out with 20%. Like, people would make jokes about it, saying, "Arey, are they like got something in an Excel sheet that every quarter and quarter they're coming out with 20% returns?" And over a period of time, people start sort of paying lesser and lesser attention to that good news that is coming out, and that causes a stock to sort of get undervalued, to be temporarily undervalued, and then it takes off from there. Value is the exact opposite. Something wrong or something adverse has appeared about that company. However, that adverse point is, or that adverse event is not expected to have a long-term impact on the performance of the company. So that is available to you at a much cheaper price than what it's actually worth. And that is what you can measure by taking a fundamental metric like price to book, or price to sales, or price to cash flow. Most practitioners in practice will, you if they're doing only the value factor and implementing it, they will take a combination of these, because at various points in time, different different proxies will be behaving differently, and it gives you more diversification. So so no one will be doing just price to book, or just taking price to sales, or just taking, they will use a combination of, another one that some people use is EV to EBITDA also, instead of using, because then it takes the capital structure out of the picture. Then you're just comparing based on the enterprise value to the earnings potential, and so even that is taken as a proxy. And there you're trying to buy against the same concept, that you're trying to buy something that is available to you at a much lower price than what it is worth.
But the conservative is just taking care of the dividend and the buyback, right?
Yeah. There it's taking just one factor, but there you're taking, because you're taking a multi-factor approach. So in some sense you are covered. But if you are implementing the value factor alone, if you choose a pure play value factor, then you would perhaps want to take more than one method of measurement.
Hi, friends. I hope you're enjoying this particular episode. I just want to take a minute and thanks the sponsors for this episode. Stoic Talks was built on a premise of actionable insights and detailed questioning, and that usually requires the independence of doing that work. When you're looking for somebody to partner with, you are not only looking for somebody who will share your ethos, but also will promote this independence of asking fearless questions without any hesitations. So, when we were looking for someone like that, the obvious first choice for me was a DSP mutual fund. I have known their team, I have worked with them for a long period of time. They have this tagline called hashtag invest for good, which I really like because it really associates, which in my observation, I have seen them living this as the way of their life, and which is very visible. If you follow their work in public, they have done some excellent research efforts. They've come up with some amazing reports which everybody enjoys reading. For example, they have this report called Netra. Then there is the transcript, which talks about the con call transcripts. Then there is the annual report Nectar, the Navigator, and many such reports, which I enjoy reading and is enjoyed by many practitioners in the investment community. So we are extremely proud to be working with such a team. They completely agree with our vision for Stoic Talks, and I really want to thank them for supporting this particular episode. And if you aren't already, I would highly recommend you to follow them on Twitter. With their Twitter ID is @DSPMF. So thanks once again, and enjoy listening this show. So, just because you have done a lot of work in this direction, probably studied a lot of literature here, are there variations to implementation of the value factor besides just the choice of the factor or the combination of factors? What I'm trying to ask is, so I mean, it's a very commonsensical thing to say that something which is, let's say, constantly generating high ROE will be always be available in the higher frame of price to book, right?
Yeah,
It will never fall at a cheap level, or it won't be the, let's say, decile 1. It will always be decile 10 or decile 9 in terms of the price to book.
correct, correct,
Similarly, a company which is probably loss making, um, or let's say very poor ROEs, will probably always be on the cheaper end of decile 1, decile 2 of price to book, right? So
correct.
one way to normalize this is to have it linked together, like the performance characteristics of the company linked to the price to book, and
Yeah.
then do the valuation with a vis-a-vis the fundamentals. The second way could probably be, I'm just thinking, while talking to you, could probably be based on the historical valuation and the gap from the historical valuation as the factor itself, and not the absolute number of price to book. But let's say if the price to book is 1 and the average 5 year is 1.2, the 20% gap is there vis-a-vis for a
Yeah.
company where the gap to average is, let's say, more or less. So is there some research or something, some working on this direction you have studied or done, or any other way in which you have taken the approach to see the value factor?
Yeah, so one different approach which AQR or Cliff Asness have come up with is so in the original paper the value factor was uh, the rebalance was done once a year, so it's a 12-month rebalance. And however they found that and that's what, and he calls it the high minus low, in academic parlance they call it high minus low, the high valuation and low valuation. uh, so they said that for the last 10 years the value factor has stopped working at all because of whatever reason which we don't know. And numerous times papers were written about how the value factor is dead and everything of that sort. What they went and did was they did a monthly rebalance of the value factor, and they found it's working. It's perfectly working as the way it should be working, and it's just that the signal was decaying much faster. So you should have had a shorter rebalance period. So he calls it HML devil. So the devil is in the details. That's what it came from. And that 1 year rebalance is perhaps something very long in today's time and age, where perhaps information is being decimated, it's disseminated very fast, or people are reacting in much shorter cycles. Cycles have become much shorter than they were before 2010 or 2008, for that matter. So perhaps that's a little bit of tweak. The other different way to do it, a lot of people have heard of this. This is Joel Greenblatt's magic formula. Where he sort of combines uh, value with quality, and then that's a different approach again. To doing this. Then there is Tobias. I've forgotten the second name. Yeah, yeah, yeah. So he does. He calls it the acquirer's multiple. So he's saying that, okay, I'm looking at how Carl Icahn would probably value companies, and instead of taking price to earnings, I'm taking EV to EBITDA. And he did the whole back test, and he is also taking into some account quality. And he also did a comparison with the magic formula, and he found that this his version of the acquirer's multiple outperforms the magic formula by quite a bit. So yes, there is there are various variations that one could suit themselves. Uh, and again, you have to be we've discussed a lot about how the implementation and the mechanics of how to implement a lot of these strategies. But ultimately it is also about is this something that you believe in, and is this something that you are psychologically and mentally comfortable with doing. And I think the difference really comes in there, in terms of implementation and in terms of results. uh, that are you able to stick to it when times are hard, or are you able, or are you just looking at a good back test and it's done well recently, so you've jumped into it, because then you will jump in and out at the wrong time, or you will keep tweaking your rules, or you will keep, and we've done and I've made all the mistakes. It's that's not that we'll not make mistakes. But over the long run, do you really believe in it? I think that is, and is your personality, or is your psyche in tune with that, or are you again going to get swayed by noise? That because sometimes people, when you talk to them and you explain to them and what you're doing, and they say, oh, so then what do you do the whole day? That now अभी तो सब computer is doing all the work ना, so then आप क्या करते हो बाकी 4 दिन या 5 दिन or whatever, because the whole thing of if you're a fundamental value investor, that you're sitting in your office reading all the annual reports, or you're going out and meeting management, or you're doing something, you're busy all the time, and you are working all the time, and you're thinking about it and all of that. But if you've automated or if you've codified your process, then except for running it like 10 minutes a week, what are you doing rest of the time?
But even
So
then, Manish, there is a recency bias at play. You know why? Because there's a criticism of this conservative formula, especially during the first quarter of 2020. Even the low volatility stocks cracked, and so that
yeah,
drawdown protection was not there. And as if
correct.
that's not enough, when the recovery rally happened, these low volatility stocks were not participating in that too.
Correct.
So you start asking your questions if the strategy is correct or not.
Yeah, actually, I also read this. Remind me where you read this, because I read the same thing yesterday. So
Oh,
yesterday,
but
in
I don't recall the exact source, but I've been doing research to
yeah, yeah.
interview
So
with
I
you.
read the same thing in the last couple of days, and so I went and looked at the India low volatility indexes. I the low vol 30, and I looked at the performance since. So actually, in India, in 2020 March 2020, we the our low vol index fell much lower. So the Nifty fell say 27% by the month end, and the low vol index fell 19%.
Yeah, yeah, sure. So this criticism is on the US conservative formula. Yeah.
Yeah, yeah. No, no. So that I also found that very intriguing. So I went and checked the India numbers on that, and I said that okay, let me see, uh, because I also read this somewhere in Barron's or in Fortune the last few days itself, and and after that also the index has out the low wall index has outperformed the our Nifty 50 or the Nifty 500. So I checked both of them. So I think since the lows of March, the low wall index is up 70%, and the Nifty 50 was up some 58%. So yeah, so and it fell 10% lesser than the Nifty 50 index.
Got it. Anish, I have just one question on a very common question, because again, my process is, even though I don't call it factor investing, but I use a lot and lot of data and do backtests on strategies. And one common question which I keep on hearing, um, which is fair to an extent and also depends on what you are testing, but we see a lot of historical data available when we work with US markets, and the factors true strength or weaknesses gets exposed when looked at the entire cycle. So
Yeah,
even though we look at the XIRRs, we also look at the length of time period for which a particular factor worked or didn't work, and we get an estimate of if past has to be guiding us, we get the understanding of what can go wrong and for how long it can go wrong, right? So um, we don't have that luxury when we work with India data. So
yeah,
just to give an example, let's say quality factor did extremely well the last decade. Okay,
correct.
but we have seen the same phase happening in US quality factors, and we then also have seen a huge non-performance of the quality factor also. And those kind of pictures become clear when you're working with that kind of data. So how do you approach this, or how do you mentally satisfy yourself when because you're practically putting that money to use to this kind of strategy? How do you deal with this yourself?
Yeah, so again, the same thing, like I said, the diversification. You have to have a multi-factor approach to your portfolio, or you have to be prepared for long periods of underperformance. Saying that that underperformance and that period of the same reason that it does not work uh, all the time is the same reason. Is it because it works most of the time? I mean, if there is no pain in a certain strategy, there is no premium for that strategy. So
Uh,
if
No, I'll probably there's a miscommunication. I'm asking, how do
okay,
you generate the confidence in your back test, because eventually you're
okay,
going to use that in your working, right? So Given that you have
Yeah.
very limited data to backtest on, we have just 20-25 years of decent quality history. uh,
Correct.
I mean, price history we still have a lot larger one, but
Yeah.
fundamental history is even lesser. So when we have only
Correct.
that kind of history, how do you generate the confidence in your backtest? Is was my question primarily.
Okay. So there are different. Yeah, I think I got that question. So I think there are different ways you can do it. One is to see that you have a first principle and very scientific approach to what you're doing. You know, you have to be honest with that. You can't be curve fitting, or you can't be just optimizing and then and running it. You know, that's the worst thing that you can do. Second, if you've even the data that is available for 20 years, a lot of it also has survivorship bias. A lot of it has, corporate actions not adjusted for, or companies that have disappeared are not available. So how do you take care of that? Have you adjusted for that or not? And until now we did not have that that luxury. So IIM Ahmedabad, I discovered much later that IIM Ahmedabad professors Jayant Verma and Sobesh Agarwal were maintaining a pharma French database. So the US, they have it right from 1928, 27. But at least these professors have it from 1992, which is when the Nifty was also born. And so 30 years of data by people that with excellent academic pedigree, and who would have done it in a much more scientific manner than most others out there. You have to see that it's broadly in line with that. You run your regressions, you check what exposure are you getting. One way to get around the time period and then is to do a Monte Carlo simulation and then run a probability scenario that, okay, this is what it looks like in the 90th percentile, and in a worst case scenario at the 10th percentile, this is also an outcome that could happen, that you could have maybe minus 5%, and there's a 5% probability, or a 10% probability that you could underperform or not do as well. So you have that probability in your mind that, okay, there's a 10% chance that could happen. You look at rolling returns over a period of time versus just looking at CAGR, point to point returns. You look at 1 year rolling returns. So then you have an idea of that, on a 1 year basis I could underperform X amount of time, versus looking at 3 years, I could underperform by this much. So then when you go out and implement your strategy, your expectations are in place, right? And then because we all come with our back test, and we expect that, chalo, I all is ready. Today I deploy my money, and tomorrow everything is going to go up, and everything will be as hunky dory, and that is probably the worst time to implement. And but if you have your expectations in place, you've done your homework, you know that you could underperform, um, and there is this X amount of probability that this could happen, then then you've sort of covered yourself, because in investing nothing is certain. You are working with incomplete information, imperfect information, and an ever evolving market.
Got it. I fully agree with you, especially that first principle part, right? If something is observationally strong,
Yeah,
and has a good economic background to it, or economic reason to it,
yeah,
then we can be much more comfortable with the outcome of the backtest itself. So you're not really a mathematician trying to find the best factors, doing the best returns. You're not doing large amount of data mining, so to speak. You are
yeah.
implementing first principles and then testing whether they work or not. So yeah,
Correct.
fully agree with you. One question I had, when you, in fact, that question popped up in my head, so I'm just going to ask now, even though it popped up in my head at the very starting. Was, you said a reason of doing rule based shift was because you were not able to capture a lot of outsized gain in the stocks where you were. Um, how do you solve that with stop losses? Because eventually, what I've also seen is larger journeys will probably have a lot of taking you out of the positions and then trying to bring you. So, I mean, generally, there's a consolidation phase in almost all stocks which do
Yeah,
large rallies. And any kind of stop loss strategy, if you put it too deep, you're anyways not using the stop loss well. So how do you
correct.
How do you deal with that, or how do you incorporate that in your working, if at all you do that, or you have given up on that? Single stock 100x is not my ambition anymore, or 10x is not my ambition anymore. At a portfolio level, I want to do returns. So how do you think about this part?
Yeah, I think you've answered that well. So I look at momentum as my stock, or I look at value as my stock, or I look at this as my stock. I'm not attached to a name anymore, or I'm not attached to that. This one is going to be a 100 bagger, or that one is going to be a 10 bagger, or this is going to. I am focusing on the fact that my strategy is going to deliver for me over the long run, uh, and that's what will compound wealth, or that's what will create wealth over the long run, because you want to be so just another correction on that, that it was not that the winners were not doing well. It was the losers that we were not taking care of, so capital was getting eroded by the losers,
Sure.
not the winning stocks, because the winning stocks would be, and most of the stocks give their returns in a 2 3 year period. 80 90% of the gains will be made in that period, and then
Sure.
they will, like you rightly said, will go through a consolidation phase, and then will come back again. So we've seen some stocks that keep coming back, but at different points in time we see uh, very very different stocks. For example, this time the PSU banks and the way PSU finance companies, power finance companies have come back. If I had 5 years ago, I would be very very skeptical, and I'm pretty sure I would have meddled with the system. I would have sort of thought of overriding something here or there or something like that. But
Yeah, have a PSU
after
filter or something like that.
I have a PSA filter or something like that, sort. And I would have missed most of because everything in the last 6 months has been about PSU and things like that. All the railway stocks, they all used to go up. We had used to have a railway budget at some point in time. 2 3 days before the railway budget, the same stocks, Titagarh wagon and something
Yeah.
and the other will start going up, and after 3 days everything will go puss, and everything the rally would fizzle out, and everything will go back down. So if we had if I had that kept that mindset, I would have never bought into any of those. I would have stuck to no, abhi, so this is temporary, or this is false, or this is fake, or this is going to fizzle out right now. And but here, uh, there's an interesting anecdote in again one of the books that I really feel that most quant investors will do, but they have a very very different approach, and I think there is only one person in the world who can do that, and that is Jim Simons. They don't look for any amount, any economic intuition. They don't look for anything. They say that if we tell you what we're looking for, you'll probably might laugh at us. And they actually revealed one of their strategies, which had a very weak efficacy, which was that stock markets do much better on sunny days than on cloudy days, because it has an impact on the mood of a person. And but they said it was a very very weak correlation. So they go out actually doing data mining. They go out actually say that we wear statistical goggles, and we go out looking for these anomalies, and then we go out there and do it. So but I would say that I don't think anybody else can probably remember that guy has this is his third career. That guy used to be a code cracker at during World War II. He used to crack codes, and he has mathematical theories named after him, and he's got the Nobel in mathematics. So I think most of us would not qualify for that approach, which has worked for him. But his partner, one in one of the meetings, was talking to a large investor, and he was saying that if my system says buy Chevron, I buy Chevron. If my system says sell Chevron, I sell Chevron. And the marketing guy is sitting next to him, and he's like turned white. And even the large investor, the LP, the large endowment fund sitting in front of, and he's also like looking uncomfortably up and down, because the company Chevron had been delisted 5 years ago. This guy had no clue that the Chevron does not exist, or this company does not exist. He said it's just a ticker symbol for me. So if you can attain that kind of nirvana where the name of the company does not bias you, because it will bias you, whether you have been an investor, because the noise around you, you cannot isolate yourself from that. You know, that will come to you that, oh, this is UCO Bank. I mean, UCO Bank, how do you buy? Or Indian Bank, how do you buy? Central Bank, how do you buy? So how do you, Punjab National Bank, how do you buy? Or so, and again, these names I'm giving for illustration, they're not recommendations to buy or sell. But to get to that level of nirvana where you don't care, it's just a ticker symbol for you.
Yeah, to
So
answer
that,
Puneet's question, I think the only way a momentum portfolio can get a multi-bagger is if we get a buy and it just runs, propels from the get-go. I mean, kind of Adani Gas or a Goa Carbon kind of.
yeah,
And even then, it will be like a 6, 7 bagger, not your 20 baggers or anything.
yeah. I doubt you'll make a 20 bagger or 30 bagger. I mean, yeah, you can make a 6, 7 bagger, and that will sort of make your 2 years.
Sure. So, okay, I have one more question on the momentum side of things. And basically, I'm just voicing opinions which I keep on hearing, and I'm just bouncing it off from you. Another common thing which I often hear is, all momentum people are doing the same thing. They look at 12 months momentum, uh, probably add volatility to it to remove very high movements in short term kind of a stocks. Um, and the more money comes to these ideas, the more crowding becomes in the same names, and eventually leads to very high slippages from the time the signal comes, and when because people are acting together in a crowded market. How do you
Correct.
address that problem, if it is a problem? If it is not a problem, can you explain why it is not a problem?
Yeah. So I think in certain market caps, uh, segments, it can be a problem. For example, in micro caps and very, very small caps, if you're doing something of that sort, it can turn out to be a problem.
Can you also just add some numerical context in what kind of size of markets you have seen this problem coming or dissipating, just for the ease of understanding for people?
Yeah, so now we just go with the SEBI definition of market caps, that 1 to 100 is large cap, 101 to 250 is mid cap, 251 to 500 is small cap, everything beyond 501 is micro cap. So anything beyond 501, and or even 251 to 500, uh, if you don't put a liquidity filter, like most people use a median uh, value traded of say 1 crore. If you have a small portfolio of 50 crores, if you put 1 crore as a median filter in that universe, you probably will filter out most of the illiquid kind of counters. Uh, so that is one way to do it. The second issue of everybody doing the same thing, uh, that uh, is, like I said, is true, but at the same time, I don't think everybody follows also what their own system at most points in time. And can it get crowded? uh, a lot of people are doing the same question will not be asked of a value investor or of a fundamental investor, that everybody is buying the same stock, and is the value going to go up because everybody is crowding in the same trade? uh, because if you scientifically design your even if it's a momentum strategy, which say rebalances once a month or once a quarter, and you rebalance it over a period of time, don't rebalance it at all at one go. If you have a very large portfolio, say of 2000 crores, let's say you're managing, and say that becomes a problem, because and you're taking say 30 stocks, that that kind of size can perhaps become an issue. But if you look at the index fund that we have, the UTI 200 Momentum 30, that has about 2,600 crores and assets under management. That's the size of the fund, and the tracking error is pretty low, and it takes the top 200 as a universe, and it's delivering momentum. Now, theoretically, like what you said, what people uh, say is that, yeah, if everybody is crowding in those same trades, everybody is buying the same names, then will it distort prices? Will it have an impact cost when you go in and out? So uh, so theoretically it should have, but there are buyers also for that stock at the opposite end. And also, if you have designed your system in such a way that if with size you've addressed it, if you have a small portfolio, let's say of say 5 crores, 10 crores, then most probably you will be able to get out without having an impact cost. uh, at some point in time there was this issue with curated portfolios and baskets that was coming into play, that every Monday you could guess that something is down circuit, that somebody is exiting, and something is up circuit, somebody is buying, and you're buying the same stocks. And but that would typically happen again in that small cap and micro cap segment, where there are circuits, and you would not be able to get in and get out, and that return that you are seeing is in part theoretical, because you're not going to be able to get out at that circuit. Not everybody is going to be able to realize that return. So that's why I think that model portfolio returns would again be say that take it with a pinch of salt, because if you're playing in that segment of the market, then capacity becomes an issue. But if you are
Yeah. So does that not okay? So the in the very starting, you also mentioned that momentum as a style is not really suited for large caps because there
yeah,
isn't much to play there in terms of momentum. Uh, there is the liquidity and size issues the moment you go beyond, let's say, 250 to 300 names. Doesn't that leave a
yeah.
very small space for the momentum investors to actually find the ideas and then operate in? Because large cap is probably top 100 names, if I'm not wrong. I don't know how
Yeah.
you classify that, but so 100 or niche 250, and then the liquidity filters leaves you a very small universe to work with anyways to find you momentum ideas. And
Yeah,
if yeah, go ahead.
that's still 300 stocks to play with. That's and and like we said, we don't care about the name of the stock, and we don't care, and those names keep on changing. So
So 300 is considering you are going. Acha, so 500 is where you're stopping your
yeah, yeah.
size limits, so to speak.
Correct.
Okay, fair
So
enough.
we are removing the top 100. So for the momentum portfolio, we've kept 400 stocks.
Got
So
it.
and we are
Got it.
trying to pick 20 stocks out of the 400. So we have still 20%. Our market cap today is what, 3 trillion, same as the GDP. If you take
Sure.
3 trillion,
Sure.
yeah, that's 3,000. So that's about 20% of that is about 600 billion. I think it's okay. 600 billion is a lot of money.
Okay. Fair point. All right. Take care. Manish, you have a
Anish,
question?
I just wanted to pick your brains on the fact if the edge is so visible in the conservative formula, how come no one in the mutual fund industry has a product yet?
Yeah, that's so. Some people do have a recently launched quant fund, uh, is broadly based on that. But see, if you look at it, Manish, any and even factor strategies are active only. They are not passive from any standpoint. But any discretionary investor won't also they be looking at similar kind of things, reaching the same place through a different process. You're trying to buy a company which is, say, sort of fairly valued or undervalued. You're trying to buy a company which is perhaps good as entering a good growth phase, which is maybe captured by the price momentum, and you're trying to ensure that it's not uh, very volatile, and or if it's volatile, it's volatile on the upside, not on the downside. So uh, so that edge is really coming from the process, and following that process. And people are, I think, have tried to get that, but Ashwath Damodaran in his book says that the day a quant investor can marry a good story with quant process, nobody can beat him or her. I think the that's one of the issues in growing a quant based portfolio, or explaining it to investors, is perhaps the lack of a very compelling narrative, which what trend follows in the US also face. So even though there can be a narrative that can be built around that, I think it's still early days, and I think also made that mistake, and I'm learning from it, that that people, even people like Jim Simons or people from his firm, say that not a lot of investors have made decisions based on data alone. They all like a good story. They want to hear a good story, and That story can be that you made high returns. Either you go with high returns. There's a very popular mutual fund house today which has grown like 30 times its AUM because it's ranked number one in terms of returns in the last 3 years. And before that nobody was distributors were not willing to touch it, and nobody was doing it, and suddenly the returns have emerged in the last 2 to 3 years. Everybody is just running after it.
So, are you saying that mutual funds are running the conservative formula, but they're not calling it that because that doesn't
Yeah,
allow them to build a story around it?
yeah, or say that it is proprietary, or say that we have our own framework to do certain things. And I think really think that the proprietariness really comes, uh, like I think it's a at the end of the day it's an empirical performance driven kind of thing, because you can go and buy a bat. I can go and buy a bat, and Virat Kohli can have the same bat.
My,
But
my
it may
question
not.
was revolving around that only, Anish. The problem is if you're not from the get go outside calling it a conservative formula, you will allow the discretion to come in, and then discretion would come in on every second decision.
Yeah, no, but even if you were to launch a conservative formula in a quant wrapper, you will still not say that this has been something that we've adopted from here. You will still say that this is something that we have built in house based on our value principles, or on our long term investment framework, which takes into account certain parameters that we have discovered over the long run that are unique to us and things like that. So even if it's a quant fund, or it's a quant system-driven fund, you will still want something, some story or some proprietariness around it. The proprietariness, because I think and somewhere it's fair. Equity in our country is still a push product. It's not. You have 2 to 3% of the population investing, so you still have to be it still has to be sold. It's not something that has is bought. So you and if something has to be sold, now think about it. Any home loan is sold not because they are saying that, okay, buy a home, it's a good investment. They say rent hua paraya, EMI hua hamara. That's how they sell their home loans, because they're telling you to buy a house, which is the worst investment ever. Or they will diamonds, the whole story about how De Beers built its story around diamond, and why now there's no engagement can happen without a diamond ring, and there's a big marketing story around it. Or credit cards or whatever. People financing a good lifestyle using credit cards. So or auto loans, or anything of that sort. Everything is sold on sentiment. And to that extent, I think I should we should all compliment the mutual fund industry, that at least this mutual fund sahi hai campaign has, I think the difference that I have seen in 2008, and maybe in the last few crisis periods that we've gone through, that a lot of people were in direct equity, and this time around, when they were in mutual funds, and especially in the last 3 years, the amount of SIP flows that have come in, they've negated the FII flows. They've just made the FII flows irrelevant. And I've been, for one, been very surprised, pleasantly surprised to see that, because in 2008 people were buying, there was all the infra stocks and all of that, and they got caught in that power stocks, and people sort of swore off equities. But this time around, because the mutual fund industry has done that job of the mutual funds IEA campaign, and put good money behind marketing, handheld investors, and made them stay through invested through a cycle. And that's what I tell early investors also. Even if it's an index fund, or even if it's 5,000 rupees, start with it, because you will go through a cycle. And the whole thing is about sticking with your equity investment through a bad cycle, because in an up cycle, though, everybody will stick with it. It's only in a down cycle that you start getting, jitters, or you start feeling that, should I exit this, and or should I time it, and should I come back later, and things like that. So I think that culture is changing. I think the youth today is sort of seeing that equity is the way to grow wealth, whether it is DIY investing, whether it's systematic investing, whatever you want to call it. But I think that trend is growing. Financialization of savings is growing because uh, the second or third or fourth home becomes a dead investment. Gold becomes a dead investment because it just stays there. Whereas when you are investing in companies, you're investing in growth of the economy. You are investing in employment. You're creating new sectors. You're creating new companies. You're backing new entrepreneurs. You're providing risk capital to that extent. So I think, and that's what our country needs today. So I think that way, I think that industry has done an excellent job there.
Anish, one last question from my side. It's been a fascinating conversation. See, what you told us is just part of the bull run story.
Yeah.
I wanted to pick your brain uh, how to not get perturbed in a bear market. When an actual bear market happens, this how would you suggest people fill this behavior gap and they don't chicken out?
So give your money to a PMS investor or a mutual fund, you know, or honestly, any equity investment will go through its down cycle. Now the problem with that is that you will see the price on television. Even real estate will go through that cycle. Even gold will go through that cycle. But somehow we have convinced ourselves that that this will come back, or
Hey,
that that
real estate का M2M दिखता नहीं है ना, so it's fine.
so it's fine. The other big problem, Manish, also is not the bear market; it's also booking profits too early, like the disposition effect that we call. That one of the reasons why momentum also works. That people sell their winners early and hold on to their losers. Now with real estate, tell me, if you buy a house and it goes up say 50% in value, you'll not say that today let me sell my bathroom, tomorrow I'll sell my balcony, third day I'll sell my parking lot, fifth day I'll sell a little bit of my bedroom. But when people have that in equity, there's this funny concept that I invested say 100 rupees, it's gone up to 150. Let me sell 100, and my rest of everything becomes free. I mean, that's that you are interrupting compounding. You are, I mean, that whole notion that it becomes free, and let me take my profit from that investment. You don't do that with mutual. You don't do that with real estate. You don't do it with gold. So don't do that with equity also. So even in a bull market, don't take profits too early, or in a bear market, don't have your expectation that, I mean, like Charlie Munger, who's turning 100 in about 60 days, says if you can't stand the heat, get out of the kitchen. That Then have your asset allocation correct. That if you, and there again, know yourself. That if you know that, so people say that if you're in a salary, if your salary is bond, if your income is bond like, then your investment should be equity like, and if your equity is if your income is equity like, say you are working at a startup, you're working in a field where you're running your own business, your cash flows are not very certain, then you have to take more conservative approach in your asset allocation and allocate a little bit less. So you should know that. But once you've allocated say that 20-30% to equity, then you have to take that. You have to go with that approach that at any point in time I can see a 20-30% downtick in this investment at any point in time.
Yeah, I mean, and funny you mentioned free of cost holdings. Earlier, I used to very similar thought process. Obviously, it doesn't make sense if you think about it that ways. But what I've also seen is that some people are able to hold on to certain stocks for years and years just because
Yeah.
mentally it is free of cost for them. So, so just because they have made it 50 rupees and they've taken out a 100 rupee cost, because
Right.
of that itself, they are able to hold on to the stock because they feel even if then it becomes 5,000, they don't care. But if they
So this
don't
is
remove that
maybe
initial 100, yeah,
maybe this is a topic for some other time. But I
yeah,
Yeah.
strongly believe this mental maths is may sound funny, but it works because you're playing with the house's money,
Yeah,
and
so mental
isn't
maths is
the
as per
entire stock market
individuals,
a
right?
mental game
Yeah,
only?
that's what he's saying, right? Know thyself. So it's really an individual's choice what works for him. If free of cost works for him, great. But if free of
Yeah,
cost doesn't work for him, like for me, it doesn't make any sense. So I'm okay to compound on that. But I also understand why somebody would want to do that, and if it
yeah,
helps him
yeah.
hold it longer, fair enough.
Correct. And even real estate, for example, some people are able to hold are will chicken out of stocks and say that at the 12-13%, then it's fine. At least if you invest in real estate at the right time, or if you invest in land, and you are able to hold on to that because you're locked in. Liquid, it's not as liquid as stocks, right? You can't call your broker the next day and say, "Ki, sell my flat or sell my land immediately." So that's again the behavioral thing, and I think that's a very interesting point because and I've written about it in my book also, Mind Money Matters, that the edge that will be available to most investors over the next 20-30 years is going to be your behavioral edge. Information used to be an edge. How even in the US now they have alternate data sets of credit cards, or how many cars are entering the mall, and they have satellites tracking all that data. Hedge funds are trying to do all of that kind of stuff today with Gen AI. They're trying to get an edge, but ultimately the edge will be your behavior. That will be the ultimate edge, and if you are able to in a crunch match situation, the person who holds their nerves in the last over is able to keep their cool. They end up winning the match. And similarly, in investing, if you're able to follow your rules, come what may, have confidence in them, and you will only get confidence when you have spent a cycle with it. You have done it yourself. You've gone down to the brass tacks. You can't borrow conviction. You can't borrow that belief.
Yeah, yeah, this is a topic of interest for me because I wrote a blog on this subject as well. Endowment bias. Funny as it may sound, endowment bias is not necessarily a negative thing. I mean, we did a podcast with Devesh Bhai, who made a fortune with his stocks, not per se because of his great research or anything, but primarily because of the endowment. He got married to the stocks and wrote the entire journey.
Yeah, yeah. No, I mean there are various people like Dolly Khanna, or uh, Vijay Kedia, and all of those people who made some 20 baggers, 30 baggers in something like Unitech, for example. He made, I think, believe his first Dolly Khanna's first multi bagger was in Unitech, which he says later turned out to be a fraud, but he made a fair amount of money on that kind of companies, and then later was in Hawkins or in things like that. But some people are able to hold on to those things, and I know one of my friends recently who put 30-40 of his 40% of his portfolio in a single stock, and held on to it, and finally after 2 or 3 years that stock has gone, I think, 4 or 5 times now. I think the ultimate thing is knowing yourself. You can't be saying I am a momentum investor today and I am a value investor tomorrow, or it's I am suddenly become options trader today, and that's where the problems start. And I think that's the worst thing that you could do.
Great conversation, Anish. Just one last question from my side now. Do you guide our audience to some of the references, resources, if they want to build their understanding, or let's say
Yeah.
even if professional money managers want to build their understanding on the factors, on quantitative, what are the best ways to go around it?
Right. So, when probably Manish and I and you, we all started 10, 15 years ago trying to read about systematic investing, quant investing in India, there wasn't a lot of research around it. So, we used to read US papers, or papers from other countries. But luckily now there are a fair amount of research is being done in India. Maybe even if we do have 2-3 decades worth of information, which is still quite a lot. So I've co-authored 2 papers with Rajan, but Rajan also himself has written almost 10 to 12 papers on factors investing and systematic investing. So if you go to SSRN and search for Rajan Raju, or you look for our paper on conservative investing or factor investing, you'll get it there. We keep. I've written a book called Mind Money Matters, which covers broadly, the concept of asset allocation as well as systematic investing. So it's available on Kindle Unlimited as well as on Amazon. So that primarily was written for to educate people, about what mistakes you should not be making, or at least what are the questions you should be asking your advisors, uh, and that and those are the things that people should be asking, because ultimately finance or math, or people think of finance is a lot of math. And Morgan Housel has this great quote where he says that finance has nothing to do with maths or any of that sort. It's how people behave with money. That's all what finance is. It's how people behave when it comes to making money, making decisions. So so the questions that you should be asking your advisors, I think, because it's not taught in school, or it's not, if you're not exposed to it at a very early age. It's changing now, uh, but that is a good resource. You could go to the Zerodha Varsity resource, is again very good. I think they've done an excellent job of putting together everything from fundamental investing to systematic investing, factor investing, options, everything they've got. So that's one great resource. There are a lot of number of seminars and videos, and of course Stoic Talks, like you guys are doing, podcasts like yourself, and on Twitter, again, a lot of people are available to talk. I think that's a great resource if you use it the right way. I have bumped into a lot of people like yourselves on Twitter. I've met you guys on Twitter. I've met Rajan on Twitter, and co-authored papers on it. So if you use a resource like Twitter the right way, I think that's a treasure trove of information waiting out there.
Great. Perfect. That's it from my side. Manish, anything from your side?
That's it from my side as well. It was a pleasure, Anish. It was fun.
Yeah.
That's it.
Thanks so much, Anish,
Thanks.
for giving us time here. It was a very
Thanks a
enlightening
lot for
conversation.
inviting me. Yeah, thanks for
My pleasure.
inviting me.
Our
It's
pleasure.
great to
Thank you
talk.
so much.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.